This podcast from the 2007 Corporate Social Responsibility Summit is brought to you by MOS, Models of Success and Sustainability.
Session 2. Deloitte's recent global survey of directors and senior executives found that while boards and top management agree non-financial data was important, firms generally did a poor job in this area. In this session, John Meacock, Managing Partner of Deloitte New South Wales, shares how regulators and consumers are demanding better non-financial information and how business must now prepare and measure non-financials monthly if they're to predict and manage corporate health and stay on top of the game.
So thank you, everyone. It's interesting. Certainly from my point of view, I would take, I think there's some great stuff in that last presentation. I'd probably take a different view on a range of issues, though, obviously, which will be controversial. But in terms of the belief of the individual and in terms of the belief of the individual driving the corporate, I think there is a hell of a lot we can do, and that will in itself will actually change a fair bit of the systemic thinking and actions. And hopefully I'll talk a bit, hopefully you can hear now, I'll talk a bit about that today and give you some of my views, is that perhaps, as I said, while I agree with a lot of information in that last one, I think there are some different views we can take. So I'm really just going to cover quickly sort of 5 areas, or 4 areas primarily, really around non-financial measures and what do we mean by non-financial measures. The view that boards are still in the dark around the true health of their business. Talk a bit about performance, governance and risk, and then draw some conclusions from it. I suppose it might be interesting in a conference like this, but what I'm going to avoid in a fair bit of the talk is actually talking around things like sustainability and corporate social responsibility. Because when we start talking non-financial measures, that's where we immediately go. And what I'd argue is it will actually make a lot bigger difference around the areas of corporate responsibility, sustainability, if we actually address the whole idea of non-financial measures and show how they, plus corporate sustainability and responsibility, fit into actually driving better corporate performance. So I'm going to talk really around 4 pieces of research that we have, and just to give you a background on what they were. We did in 2004 a study across the globe with Economic Intelligence Unit around 250 global directors or directors of global organisations around what sort of non-financial information were they getting at the board table. And then we repeated that study in 2006. So the first study was called In the Dark, the second one very innovatively called In the Dark too. And really it was comparing what's happened from 2004 to 2006, what's changed. As just mentioned, we've just done an interesting study interviewing 100 chairs and directors around ASX 200, and we asked a range of the same questions to get that Australian view around what's happening in terms of non-financial. And also part of that, we actually have held some forums with about 40 ASX CFOs. So very much the sort of cream of global business and then local and Australian business, to get an understanding of really what did they mean around non-financial and what sort of information were they getting and what was driving perhaps some of the changes that we're seeing. As I said, one of the things that I want to sort of talk about is when we talk about non-financial is talk about a much broader set of information than just purely sustainability or corporate social responsibility. And I think it's important because I think we have to if we want to make a difference around corporate responsibility and sustainability, we have to take it into mainstream. And, I think these things interesting when you start talking about what is the level of non-financial information that organisations are getting, customer satisfaction, the whole range of things around operational performance, how's the business performing, what's happening in the business, things like innovation, what are we doing around innovation, product service quality. All of these things become incredibly important in terms of driving mainstream business. And they also are incredibly important if you actually think about the linkage into some of the corporate responsibility and sustainability areas. So I want you to actually think a bit more broadly on this. It is interesting when you talk to major corporates, and major corporates have started to move on this. They've still got a long way to go, but what we are seeing is that major corporates are starting to believe in the much greater need to measure non-financial than we have in the past. They're also starting to believe the much greater need for integration of things like sustainability, corporate social responsibility into their core strategy, into their core information and core systems. And there's some good examples. Certainly one of the organisations that I do a lot of work with is Qantas. And they, over the last, since about 2003, have done a huge amount around bringing into their mainstream board reports, their financial statements, their sort of management reports, if you like, the sort of information around employee commitment, customer retention, customer satisfaction, a range of the operational performance, and then more and more now bringing in things like carbon footprint, emissions, all the sort of things that you would expect them to see. But they're one of the organisations that we're starting to see make a significant difference in this space. So why do we think it's important? This one really, while very much just sort of diagrammatic, I think shows the why we do believe it's important. From a financial point of view, clearly if you look at what is current today's financial performance, you come up with one value for the business. Really, a sustainable business value is around a range of these non-financial information, because in our view, a range of the sort of non-financial measures are actually the sort of leading indicators, if you like, of future financial performance. And again, it's probably why I come back to sustainability and CSR in this area. I think it is one of the key measures that will be actually key in terms of future financial performance. And future financial performance is actually what drives corporate value. So if we can actually bring this in, integrate it, and start to make this the common language and the common information that organisations are getting, it will have a bigger and bigger impact on how organisations are perceived, but in particularly how they're valued. So, as I said I wasn't going to go a lot into this area, but it is an interesting area, and I think it is increasingly important. Certainly from the studies that we've done, the ones I mentioned before, some of the studies that you read from McKinsey and a range of major sort of consulting firms, is that more and more CEOs are starting to bring the ideas of corporate sustainability, corporate responsibility into their core strategy. And it's increasingly important when we see things like both sides of the political party, parties saying that from 2011, 2012 we're going to have carbon trading regimes. Interesting enough, we think most businesses haven't realised the implications of that. Certainly in terms of the information we have is that both sides will go down to impact about 75% of the businesses in Australia. That is far more far-reaching than any other country in the world. And so one of the interesting things that we're seeing is we're seeing a lot of sustainability reporting, a lot of people putting out greenhouse gas targets, etc. We think a number of those will have significant implications for them down the line, because they're putting out often ill-conceived targets. They may be very admirable in terms of what they're saying they're going to get, but it's going to have significant and interesting implications for these organisations when it comes to what they see coming out of the carbon trading regimes and what it does to their valuations. So, there's some interesting things happening around that. I'll talk a bit more about the talent market. My view is, and one of the things I always say to CEOs, it really doesn't matter whether they believe that climate change is real or not real. I mean, in terms of they have to act, because the impact on things like talent markets, the impact on what it will do around brand risk and a whole range of those sort of things are incredibly significant. So the key, I think, in terms of motivating some of these organisations to change, and I think we're seeing most good organisations doing significant change in this area, but is actually, as I said, is not so much whether they believe climate change is real or not, but it will have fundamental impacts on their business. So we're seeing a range of those. We're seeing, interesting enough, more and more things like government putting requirements for, responsibility practices. You're seeing a range of major corporates, the BPs, and it's interesting, some of, the global organisations that were 20 years ago the ones that were seen as the big polluters, but now leading the charge in some of the corporate responsibility areas, are actually driving the systemic change, because they're forcing people in tenders to actually make sure they comply with a whole range of requirements around corporate responsibility. So if I just go back to, if we have a look at some of the information that came out of the surveys, out of In the Dark 2, it was interesting that 87% of organisations said they were getting good financial information, but only 29% said they were getting good non-financial to boards. it was interesting that 85% of organisations where there was over $1 billion of revenue say that financial information alone does not capture the underlying strengths and vulnerabilities of an organisation. So, very significant percentage. They're saying that 56% said that financial information fails to add any value to the look forward or future prospects. 83% say market increasingly emphasises non-financial, and 37% said that the organisation was driven more by intangible than tangible assets. So I think hopefully that message is very strong, that people are seeing that this collection of non-financial information, which clearly includes things like corporate responsibility, and corporate responsibility is a big driver of, are seen by businesses being increasingly important in terms of how are they going to perform in the future and what's the future prospects. Just to mention a couple of them, what are the drivers? The really interesting thing, what happened between the two, in the dark 1 and in the dark 2, was that a massive increase in view that organisations needed to collect this information, needed to act on it, but in fact very little had been done. So over that 2-year period, no great improvement in information, but a huge increase in awareness that something had to change. And I think and it was one thing that mentioned that a lot of our people coming out over the next 20 years won't get jobs. Certainly in the Western nations, and particularly in places like Australia, it's going to be quite the opposite. The war for talent is massive. 2007 is an absolute defining year. For the first time in Australia, demand exceeds supply. So in terms, had to get that right. So for the first time, we have more jobs than people, and over the next 20 years, that is just going to get worse and worse and worse. So it's a pretty interesting stat around war for talent. And as an organisation, Deloitte, we now recruit 500 graduates out of university a year, so it's a big number of people. The really interesting change that we've seen over the last 3 years is the first question is not about job prospects, not about dollars. It's really around responsible business practice, corporate sustainability practices, inspiring women's programs. Those sort of things are the first things they ask. It's not about, what's my job prospect. So we've seen this massive change in the market. There's some really interesting stats around the research that certainly we've done. 50% of your staff will be contacted over the next 12 months about moving, and 85% of them will have the conversation. So the market for talent is just so real, so hot. So if there's anything that's going to drive, in my view, this change to non-financial, change to, are you a responsible business? Are you going to do more things in this area? This whole war for talent issue is absolutely fundamental. And it's across all areas. It's engineering, it's financial. There's something like 10,000 vacancies in the financial services industry in Australia. So, we've got a very, very significant, but it goes down to posties, to semi-skilled, unskilled workers. We have a fundamental shift in our economy that I think is incredibly important. The other one that I talk about is, around the change in things like internet. It is interesting around how about customer satisfaction now, and about product and service quality, how quickly that information gets back. And I always use the example that amuses me. Hopefully it amuses you. But a few years ago, I was going with my family to the US, and it was one of those things, and we were looking at going to Disneyland, and looked up on, I'd never used Expedia.com before, one of the internet sites to sort of where they rate hotels, and it was the first site that I came up with, seen this hotel that looked good, pulled up the sort of explanations, and the first thing was, we found a mouse and it wasn't Mickey, so... And from that, clearly didn't stay in the hotel. Clearly a lot of other people have read the same sort of thing, not staying in that hotel. And I suppose it brings back to me the power of the internet, the power of the ability to shift and get information now means that, the whole desire to make sure you've got good information around customer satisfaction, about responsible business around these sort of areas, actually is just going to get quicker and quicker in terms of ability of customers, suppliers, everyone to find this information out, and I think it will drive a fundamental shift in what we do. So from the studies that we've done, what's driving the shift to non-financial? It is interesting. A range of things are driving. The highest one there is this whole area of reputational risk, and clearly organisations are very concerned around, what do other people see us as, what are our views. So again, I think if you think about it from a responsible business point of view, that's incredibly important. You can see that the two at 62% there, increasing customer influence, increasing employee influence is seen as incredibly important. And you've got sort of around the 54% of respondents talked around NGOs, lobbyists, civic organisations. So, I think this is having a very significant impact on organisations. Organisations are changing, and particularly they're changing the need for the sort of information that they require to be able to actually manage their business going forward. So then, why are boards still in the dark? There's probably 4 issues. I've got 3 here, but I think that the sort of incorporation of responsible business, sustainability into corporate strategy is fairly new. So I think that's still people coming to grips with it, if you like, in terms of understanding it and therefore understanding what information that they need. But really I've listed 3 areas and I'll go very quickly through them. But firstly, systems and tools, linkage and CFO reticence. One of the great problems is that our financial systems, have been built up over a long period of time. They really only collect financial data. Or if they collect a lot more data than that, the ability to extract that data is difficult. So one of the things that I always think is very interesting when you go and talk to the CEOs and boards of top 200 companies, generally they're very supportive around the whole corporate responsibility, sustainability measures, but their ability to extract that information. You go and talk to most CEOs and CFOs and they'll tell you they'll set a target around either various elements of responsible business and then hope like hell for a year that they actually hit it, because their ability to measure it it's a once-a-year exercise, incredibly difficult to do. So one of the real barriers is the ability to, and I know from staff often you get that question about, why aren't we measuring this, why aren't we doing more about this? A lot of it's incredibly difficult. It creates a whole range of different techniques, be it survey techniques, etc., that really businesses haven't been used to doing. So there's a lot of investment going into this, but we are still a little way off in terms of getting really great ability to actually get this information. And I get concerned when we start talking about 150 metrics, as we saw on the last slide, because once we start talking those sort of numbers, we're doomed. So it's really getting it back to starting with a few small things that we can measure and really start to deliver on, and then build that understanding and knowledge over time. Things like data analytics are some of the answers where clearly we're getting better at the ability to extract and understand data, but I think it's one of the big issues that most corporates are facing. Linkage, again, we can say it's very obvious to see how some of these things, like employee engagement, link to shareholder value, and some of them are, but some of them are quite difficult. It's a leap of faith. So it's getting, again, the better we have information, the better we have data, the better we have ability to link this stuff. And I suppose my key message coming back to you all the time is if we can get the sort of corporate responsible type measures, those sort of things into mainstream, will have a massive impact on what happens. If we treat it as very much something we just report and it's something we should do, then I think it'll take a lot longer and be more difficult. So it's really around getting that information in, but primarily too, it's also about what's right for the business. One of the things again that we see is we try and over-regulate. We actually say that everyone should report this whole raft of information, but if it's not right for the business, why are we reporting it? So the key is what is fundamentally important to the business, what is fundamentally important in terms of driving this business forward and making sure they're the sort of things we're reporting, not imposing some sort of regulatory framework. Because regulatory frameworks are important, but they're clearly not the answer. It's getting this, I suppose, the power of the positive motivation rather than regulation. And there is clearly some CFO reticence. There is some concern, partly for the two things that I mentioned before. Their systems aren't up to the linkages aren't as good as they'd like them to be. But there's also, again, some CFO reticence around getting boards too involved in the detail, that certainly from the stuff that we've done, that CFOs are concerned about providing too much non-financial information. But interesting enough, what were the top 4 areas which CFOs believed they needed to have better information? Employee commitment, customer satisfaction, greenhouse footprint, and quality and governance and management process. Now, interesting enough, in the major piece of research where we interviewed the top chairs from the ASX 200, they saw talent as the number 1 issue, they saw corporate governance as the number 2, and they saw CSR sustainability as the number 6 issue of the issues they placed on it. The interesting thing about that was the number 1 being talent and the number 6 being CSR. Their view was that management weren't doing anywhere near enough to actually address it, so boards were putting a lot of pressure. And the interesting thing is, what we will see as that filters through is that you'll see boards putting a lot more pressure on management to actually do something. Just quickly cover through a few of these, because I know we're sort of short of time. We have seen some quite significant corporate governance implications. We have seen a lot of regulation. Interesting, 3 years ago, there was not a lot. The only area on risk was, thank you, I'm getting a sign from up the back, was very much around financial risk. What we've seen today is really, if you go to things like the ASX governance principles, a big shift to areas like operational risk. And by operational risk, we're talking right back into sort of some of those fundamental business performance and sort of particularly non-financial type information that we had that I've talked about before. So regulators are having a much bigger impact, and we've seen things like Basel II, which completely redefined the way the financial system measures risk, but going into a lot more of these non-financial type risks. So again, the regulators are moving things in this direction. But again, I don't believe regulators are really the answer to this. Yes, they can have an impact. Yes, they're important. But it's really organisations seeing this as absolutely fundamental for their mainstream business, and a desire to do it is actually what's going to change it. It's not just what the regulators can do. Because, there's no question, and we've all heard it before, I'm sure, but, Enron ticked every corporate governance box you could actually pick. It was the fundamental flaw in the individuals that caused the Enron collapse. It wasn't actually a fact that they didn't tick the corporate governance guidelines. But again, and some of those sort of things that we're talking about in terms of corporate governance and getting corporate governance right, there's systems in place to measure and making sure that we are collecting the right information and focusing on the right things. So it's interesting when we asked, and I gave you the sort of in the dark, which were the global stats before, when we asked some of the local organisations or the chairs of the top local organisations, it's interesting that we did this study over the last four months, so it's just being issued, compared to the last In the Dark 2, which was in late 2006, so basically a year on. And interesting, this number in the global study of 74%, it was 37% in the global study. So, it's double what was said in the Dark 2. I think that comes from two factors. I think it reflects that even in a year, how quickly we've moved in this space and how quickly organisations have finally got it. But it also, I think, does reflect perhaps the strength of Australia as a service-based economy. 92% said that non-financials gave them much better forward-looking information rather than historical, and 95% of Australian chairs of top 200 companies are saying that their company is driven more by intangibles rather than tangibles. So again, this very strong theme that it's things like engagement of people, the power of people, that become critical to financial success. So I think you can start to draw those linkages through to responsible business. Interesting, when we ask them who has responsibility, The sort of bluey colour, if you like, was management. The reddy purple colour is boards, and the whiter colour is shared. We asked them who has financial responsibility. 65% there was management, with board very little. It's interesting as you move down into things like shareholder value, and particularly into things like responsible business. The boards are saying they get far more involved either directly or in a shared responsibility. So it's interesting that we're seeing the boards starting to have a much stronger role in terms of how organisations are performing and what they're measuring and what they're doing. And it actually concludes with one of our major findings from this report, that we've had an interesting change in terms of organisations, particularly in Australia. I think the last 20 years we've had the dominant CEO who's been the single voice, the guru CEO, if you like, the single voice and face of the organisation. We've had a real pendulum swing back to now where the board is far more involved in terms of setting corporate strategy, setting corporate direction. And that has clear implications when you start to see numbers like this, where the board, 63% of the board says either it's their responsibility or their shared responsibility with management around corporate social responsibility. So I'm conscious of time. Just to give you some quick conclusions, non-financial information is becoming increasingly important for organisations. Boards and management have realised, but from the studies, little has changed. But there's no question it's imperative to measure both financial and non-financial. Clearly, financial allows you to actually do a lot of the other things that you want to do, but really, non-financial is what's going to drive a lot of the value of an organisation going forward. Yes, there's no question that systems and linkage are a barrier, but you can't use that as an excuse. Organisations are investing a lot of money in this. It is difficult, but it's increasingly important they do it. As I said, regulation is forcing us down this process, but would certainly hope that it's not the driver. And as I said, good governance and corporate performance really should be the things that are the drivers of measuring. We have seen, we've got some organisations making some extraordinary grounds in this area. So I think, and I think there are very few, despite often some of the view of the major corporates, there are very few that aren't starting to act on this. I think that pace of change and the pace of acting on it will just keep increasing and increase very rapidly. It is the responsibility of both board and management. So thank you.
John's going to be with us over morning tea, and then he's going to be back tomorrow, where we're going to take a look at some of the gaps in the market and what Australia needs in terms of catching up, where I know we'll cover some of this ground again, as well as some new ground. I actually have a quick question for you, and I know again it's going to be covered later in the program in another stream, but what is it that you think is going to get boards to change? I mean, you said for 2 years they've known about this, but things haven't changed. What is it? I know it's slowly driving, but what is it that is going to get this change much more quickly?
Look, I think all these things take time, so I'm actually extremely positive that it is changing. As I said, but I do think it is things like, I think that, to me, the corporate social responsibility debate's a really interesting one, where you've almost got 2 levels of real change. I think you've got the boards starting to see it, so there's an older generation that wants to give back and is very concerned about these issues, mixed with what you're seeing in terms of the youth coming through who is seeing it as very passionately. So what you've got interesting is, I think, some of the more conservative middle management actually sort of sandwiched in the middle. So, I think it's that mixture of all these things when you start to add customer influence, employee influence, all those things coming together, and boards seeing it and putting pressure on management to say, hey, you know what, this is about the true sustainability of the organisation, the true profitability of the organisation. Unless we address it, we're not going to get there. And I think the war for talent, the talent crunch, is probably the biggest issue going forward for organisations, over the next 20 years in Australia. I think most people have underestimated it. It is going to be a massive issue, and particularly where you've got a lot of that talent who believes very passionately in sustainability, I think it's going to have a big impact on organisations.
So patience is a virtue for the CSR managers in the room, and I know there are a number of you who are totally frustrated of the lack of movement, particularly by your boards. It sounds like it's coming. So do we have any? We'll take 2 quick questions from the floor because we do need to wrap up. We've gone a little over time, and we do have somebody this morning who needs to catch an international flight. 1 question down here, and any other questions? We'll have another microphone down the front for Paul.
I'm Carolyn Wilson. I'm from World Vision, and my role at World Vision is to help corporates, I guess, tackle these issues. And I guess I just wanted to get your thoughts on around the fact that I believe that organisations, and I agree with you that the majority want to make a difference, but they don't quite know how. And I think it's those tools, the how you can take a holistic approach, things like that are what we can do as an NGO to support these organisations. And I just wondering what your thoughts are on that.
Yeah, look, I think it is absolutely. I think that's a good point. It is knowing how. I think, as I said, I think one of the things is working with them to actually bring it back into mainstream. Though, my fear always on things like sustainability, and I'm very passionate about it. I actually have responsibility for it in Deloitte. But if we actually leave it as, hey, this will be really good to do, and it'll actually be an add-on for staff and those sort of things, you won't get there. So it has to be brought back into absolute mainstream. I think that's why I go very strongly on war for talent. I think that's the easiest way to bring it into mainstream, and we don't always have to do it first principle. So I think it actually is bringing to an understanding of, I think war for talent, I think sustainability. If organisations are smart, they look at it in terms of what's the opportunity, I can do something different and create an advantage here. So, I believed in the video, or the first speaker, I think that idea of helping corporates to understand what is the competitive advantage they can get by actually adopting sustainability and some of these areas is actually the most fundamental thing you can do. So it's not easy, but I think it's pitching it in, if you can pitch it in that frame and work with them from their core strategy and how the sort of either sustainability or various other practices that we can do actually enhance their corporate strategy, enhance their competitive advantage, is the easiest way to get organisations to wake up and make a difference. And the classic examples, IAG have seen it absolutely fundamental to their business in terms of insurance, climate change, and have been a real leader in this space. Westpac saw it as a marketing advantage and have done extremely well out of it by defining, the banker who's signed up to various global protocols and that sort of thing. So people who see this advantage, see as a way to get in, then really make a difference.
John, my name is Paul Wade, and thanks very much for that talk. I thought it was a really interesting contrast to Frank's, and certainly with a much more a local perspective. Your comments, particularly on carbon trading, I think are spot on. Terry McCran writes about it again in the paper, and it's nearly every day someone's writing about it. We've got unprecedented growth. I mean, as far as the economy goes, we're going to be ripping through with shipping out resources and commodities more than we can cope with, and more than the orders come in. But I guess, I just wonder if you'd comment, there seems to be sort of a schizophrenic approach from what I see with a lot of the big corporations in Australia. You're absolutely right with people wanting to work in a good, sustainable environment, and certainly there's the big companies, the really major ones, have employed great spinners in the form of the top, most expensive communications companies to say how they recycle their water and their paper and all the rest of it. But that whole thing about the carbon emissions and the really hard stuff seems to be sort of put somewhat on the back burner, and I'm just wondering how somewhere along the way there's all those conflicts of interest are going to have to bubble to the surface at some stage. Yeah, it is.
Look, there's probably, I'm not sure the answer directly, but certainly I suppose a couple of thoughts on it. One, I think where top corporates are being forced to it, either because just purely to compete or because they're being forced at regulation, then I think you do get the corporate spin. And that's the risk, and that's why I always get fear. These sort of, someone wants to put a new ASX or anyone else wants to put a new governance principle out or something that actually forces people to do something, because classically the more you regulate, the more people do enough to tick the boxes and, don't actually ingrain it. I think what Australian boards are just starting to see, though, is that some of these organisations are getting significant competitive advantage by it. And when when it's brought back into that heartland, you will see a difference. I think you see our property organisations taking it on very strongly because, I went to a talk by, Lend-Lease. The comment was that in essence they were forced to by BP, who basically said unless you've got, you meet sort of A-grade ratings on your buildings, we're not going to be in them. And BP made about 10 or 15% of Lend-Lease's value. So it actually is being forced by others who are seeing the need for competitive advantage. The other interesting comment, going back to the first speaker too, is the really interesting thing about someone like Walmart, organisation like that can have a major change. The interesting area that why did Walmart change? I don't think it was any altruistic or desire to change the world. Initially they were forced. I spent a long time with one of their key directors a couple of years ago. The interesting thing was that they had gone from an environment where the CEO used to spend a lot of time with customers in stores addressing the positive issues. They had really let their supply chain fall, hadn't been looking at a lot of these forward information, forward views around the health and quality of supply chain. They got hit by an absolute massive wall of litigation and, suppliers going bust and those sort of things that actually forced them to completely rethink around health of supply chain, what they were doing around sustainability. And so now you've got Walmart going from, here to here in terms of what they're doing around sustainability. So I still think it comes back to, I know I've sort of given the same answer again, but it's that bringing it back into heartland around what's it going to do to your competitive business, what's it going to drive, particularly in the forward view, that'll actually make a difference.
Yes, we've certainly got the action, but we've certainly got the belief, but it's embedding, it's that part of the action that we're really missing, but we're starting to make headway. Talking about